Hi there, welcome to Neppy Invest. I love profitable small cap companies, and today I'm going to give you two small cap companies that are a potential buy. One of these companies I do know a fair bit about, and I've actually been a shareholder twice. And the other company I didn't know a lot about, but as I did a little bit more research on them, I do find them fascinating and interesting, and the fact that I actually do use a fair few of their products. So let's get stuck into it. And the two companies I'll be focusing on today are Shop and Pental. So most of you probably know who Shop is. You've probably gone through them, especially if you're a shopper. You like to go to malls. You've probably seen a Shop around. Pental, maybe you don't know what Pental do. They are a manufacturer. And I read something the other day that in 2016 they were the largest soap manufacturer in Australia. So I'll go through both of these companies, look at some of the fact sheets, some of the financials, cash flow statements, historical financials, and I'll end up looking at the weekly chart. So the first company I'll look at is Shop, ticker code SSG. Now the market cap was only 144 million, and considering they have $212 million in revenue and $52 million operational cash flow positiveness, should suggest there could be some good value here. So compare that market cap to the operational cash flow, and you're looking at 3 times, or the market cap is 3 times operational cash flow, and that's low. But when you take into account they have $41 million of cash on hand, the EV to operating cash flow is 2. Typically, I look for numbers less than 6 there for a good value play. So this would suggest Shop is potentially a very good value even at these prices. And the share price has run up a fair bit over the past 9 months or so. Now, a few years ago, this company did list. And when they listed, I started going past this Shop every single day just to see how business was doing. And every single time I went past this shop, there was no one in there. So I thought, oh, this is like another Dick Smith. If you remember Dick Smith, that electronics store, I did the same thing with them, and every time I went past them, there was no customers in the store. I went in a few times, very quiet. You compare that to JB Hi-Fi, which is completely different. Now, in about July of last year, I did actually go into a shaver shop because I needed an electronic razor, or clipper, whatever you call it. And I stayed there for about 15 minutes. And in those 15 minutes, the amount of customers that came and left was quite high. So my opinion of Shaver Shop changed in that one moment. And there's those financial numbers that were coming in, profit upgrades, that sort of thing, kept me or made me more interested in this company. And I haven't been a shareholder since then. There was an obvious buy back. I think it was either May to June or July, sometime in there. I'll show you when we look at the chart. But there was an obvious time to buy back then. But this company is still good value. You might argue that the run-up in share price, the good financial numbers, just because people are spending a lot more because of stimulus, that sort of thing, and these numbers will fall off in the next year or so. But mine goes back to the fact they have $41 million of cash on hand, and they can do a lot with that amount of cash. On to Shop's cash flow statement from the half yearly released on the 19th of February 2021. And there's lots of things to like about this cash flow statement. The first thing is receipts 136 million, and you can compare to the previous year, which was 115 million. Operational cash flow positive of 41 million, and even last year it was 29.3 million. So the market cap of the company about a year ago was significantly less than it is now. So those numbers were quite impressive. So far, lots of ticks coming through here. The fact that operational cash flow positive 41 million with a market cap only 144 million. So that's, 3 times. Market cap is 3 times operational cash flow. And this is half year. This is not full year numbers. This is half year. So, of course, they probably won't keep this up. And I'll show you why they won't be able to keep it up in the next half year. So this is a seasonal business, if you can believe it. So Capital expenditure, only 1.3 million. So they're not a capital intensive sort of business. Maybe if they do some shop remodeling, that sort of thing, maybe they can become capital intensive for a short period of time. But they're not like an airline company or like Freedom Foods, which I did a video on that the other day. Dividends, $5.9 million of dividends, and they could really increase that by a fair amount considering the cash inflow from operations this company has. So they have a pretty good dividend yield. And even though they're spending $5.9 million in dividend yield, they did grow their cash by $12.6 million in this half year from $28.4 million to $41.1 million. So everything's looking really good for Shaver Shop. In this slide, what I'm showing you is some of the financials. I'm looking at operational cash flow, free cash flow, which are the blue and orange bars in the graph. And I'm also looking at revenue and market cap. So revenue is the red line and the black line is market cap. And the first thing that is fairly obvious when you look at this graph is the seasonality when it comes to the performance of Shaver Shop. So the first half year of the financial year tends to be quite stellar for this company, and the second half year tends to be quite subdued. And I think the main reason behind that is a lot of people buy Christmas presents at Shaver Shop. That's the only thing that makes sense, because why else would there be seasonality in this company? And there is a massive difference between the two half years when it comes to Shaver Shop. But the main thing when I look at this is you have to compare previous corresponding periods. So you can't compare half year to half year, because if you're comparing this half year to the most previous half year, the growth is stellar. But if you compare the most previous half year to the half year before that, things look quite dire because it went down quite substantially. So the main thing here is you have to compare corresponding periods. You can't compare half year, you have to compare year to year. And when you do that, you can see a growth in this company's financials. And operating cash flow, for instance, operating cash flow 2016, the first half, was $14.9 million, and this half year, $41.5. And if you go back to the worst half year, in 2019, the second half there was negative $5.7 million, and in the most previous half year, $10.5 million. So we are seeing improving numbers year on year, and that's a good thing. So we are seeing growth in this company. And when you compare that to the market cap, a company that is growing with a small market cap, low valuation, this could be a fairly good buy right now. To confirm whether this is a good buy right now, what I tend to do is compare the growth rates of revenue, operating cash flow, and sometimes free cash flow to market cap and enterprise value. And what I tend to see or find is when revenue and operating cash flow are growing at a quicker rate than market cap enterprise value, there is potential of some good value there. And what we tend to find is some mean reversion over the long term, where if those three metrics are growing faster than the market cap, you'll see later in the next few years that the market cap will have to catch up, particularly if those growth rates continue. The market cap of a company has to catch up to the financial growth rates, and vice versa. If you see the market cap enterprise value of a company growing at a quicker rate than revenue and operating cash flow, that is suggesting that the share price might not grow at a quicker rate, because the financials of a company have to catch up to the valuation growth rates of the company. We saw that with Microsoft about 20 years ago. The market cap or the valuation of the company grew at a much quicker rate than the financials, and then for quite a few years, the share price did nothing because the financials had to catch up. I hope that makes sense. But anyway, with Shaver Shop, revenue has been growing at 5.6% per half year, operating cash flow at 13.7%, and free cash flow at 16.2%. Now, if I didn't look at the market cap and enterprise value growth rates, I would think that the market cap and enterprise value should be growing at between about 10 and 15%. The reason behind that is because operating cash flow and free cash flow have been growing at those rates, and I'd like to see the market cap growing at similar rates to that. But when you look at the growth rate in market cap and enterprise value of Shaver Shop, it's significantly lower than the financial growth rates. So market cap has been growing at 4.6% and enterprise value at 1% per half year. So just looking at these growth rates suggests to me the share price could go on a bit of a run to catch up to those financial growth rates, with the assumption that those financial growth rates continue going at those rates. So it is an assumption to make because it might not happen, because the financial numbers in Shaver Shop might slow down over the next year or two. So you might question, why is enterprise value growing at a slower rate than market? Well, that's because Shaver Shop's cash on hand is growing quite quickly. It's up to 41 million. So those enterprise value numbers are down a fair bit. So I'm really interested in Shaver Shop, what they're going to do with that cash on hand, because they could do quite a few things. They could do an acquisition, share buyback, increase the dividends by a fair bit, or they could spend that money in growth initiatives. So very interested to see what they do. But again, I'm trying to talk myself into buying Shaver Shop, it seems, because I'm not a holder, and this is really looking like a real good or potential good value play right now. And this is the 3-year weekly chart for Shaver Shop. Now, I have been a holder twice in the past with this company, and both times I sold out at a a medium profit. So I bought in around about April of 2019 at about 35 cents, and then I sold out when the share price got to about 70 cents. So it was a double bagger, or a bagger for me. And then when the share price went through the COVID-19 financial panic, got down to as low as nearly 20 cents. That should have been a dead giveaway to buy in to this company, because they were still going to be profitable. They were still going to be working, still going to have that online business, that sort of thing. And the share price has gone on a big run since those COVID-19 lows of about 20 cents. And right now, it's just above $1. Share price has gone sideways over the past few months or so, but that's not a bad thing. You want to see some consolidation in the share price. And I think if they can give out some good guidance in the future, the potential there is for the share price to go on another run. So I've decided to break down this video into 2 parts. So this is the end of the first part, looking at Shaver Shop. And in the second part tomorrow, I'll release Pental's little discussion. So stay tuned for that. I didn't expect the Shaver Shop part to run as long as it did. So that's all for this video. Have a good day. Bye.